Hello, welcome to inventory costing class. In this chapter, we will learn different ways to assign costs to ending inventory and see its effect on companies' income, pricing, and other crucial decisions. We will mainly look at variable costing and absorption costing methods. You are familiar with the term variable cost already, costs that move with a driver. Absorption is just a technical term for full costing, one all manufacturing costs, whether fixed or variable, are charged to production. Let's jump in. Let's make our point with the help of a simple example. We have a company here that made 10,000 units but sold nothing. So what should be their cost of goods sold? What should be their ending inventory and net income? Does it sound natural to you that if the company sold nothing, then its cost of goods sold should also be zero? Also, all its costs should be carried forward as ending inventory, leading to a situation of zero revenue, therefore zero cost of goods sold, zero gross margin, and therefore zero net income. Does that make sense? Now, let us say that out of the total $50 cost of making a unit, $10 is fixed cost that had to be paid each month, whether you sold or even made anything or not. For example, rent. Then, should the company not charge a loss of $100,000, I mean $10 per unit times 10,000 units to the books? Also, what should be its cost of goods sold? I hope your answer is still zero. If I don't sell anything, then I can't have a cost of goods sold because anything that I use as a per unit cost will be multiplied by 0 units sold. What about ending inventory? The question here really is, should the company carry all $500,000 to ending inventory or carry only $400,000 and charge the $100,000 to books as period cost? In other words, whether fixed manufacturing costs should be inventoriable or not is the real argument here. Which one should a company choose? But before we decide which approach is better for the company, we should know why we should care at all if fixed cost is taken into inventory or not. The answer is that the higher the inventoriable cost, the higher is the company's net income. Notice that in the first case, net income was zero when we took $50 per unit as our inventoriable cost. When we brought the inventoriable cost down to $40 a unit, net income is lower by $100,000, which is a very big fall in a company's yearly income. So naturally, companies would prefer to choose a method which will show maximum income but might lead to decisions that will hurt the company in the long run. There are 3 inventory costing methods in use, although only the first 2 are more popular. Absorption costing or full costing is a method of inventory costing which includes all manufacturing costs as inventoriable costs, whether they are fixed or variable. In this sense, inventory absorbs all the cost, hence the term absorption. But this is the costing method you have been seeing throughout this course. Generally accepted accounting principles and IRS also require companies to use this method for inventory costing. Variable costing includes only variable manufacturing costs as inventoriable costs and treats all fixed manufacturing costs as period expense to be charged to income statement for the year. Throughput costing includes only direct material costs as inventoriable costs. All other manufacturing costs are expensed in the period incurred. This method is preferred by companies where labor is largely paid as fixed salary rather than as an hourly wage. So, direct labor is not a variable cost for many of these companies. In many other companies, direct labor is too small a number because of automation to include in inventoriable costs. Please note that the entire discussion here is about manufacturing costs only. All the 3 methods exclude non-manufacturing costs. So neither method will take any selling, general and administrative costs into cost of goods sold as well as into inventory calculations. Also note that the 3 methods will come up with 3 different cost of goods sold numbers, leading to 3 different income levels and 3 different inventory numbers. Now let us look at our example again. If the company's total manufacturing cost is $50 a unit, which is made up of direct material, direct labor, and fixed manufacturing overhead, then what will be the three numbers of cost of goods sold, ending inventory, and net income under the three methods? Under absorption costing, the unit cost would be $50 per unit of inventoriable cost, leading to 10,000 units times $50 per unit of ending inventory, and cost of goods sold and net income should turn out to be zero. Under variable costing, only $40 per unit, that is direct material plus direct labor, will be the inventoriable cost, leading to 10,000 units times $40 of ending inventory. Cost of goods sold would be zero and net income would be negative 100,000 due to fixed costs. Under throughput costing, you should get 0, 300,000 and $200,000 negative respectively. Notice that higher value of inventory for each method means higher income for that period. We will come back to this point later. Before we move further, let us get very familiar with the income statements under the three approaches. Remember, in absorption costing, costs are classified by character. If they are manufacturing costs, they would be inventoriable. Under variable costing, costs are classified by behavior. So, in absorption costing, we will make an income statement of the traditional type in which we subtract all manufacturing costs from revenue and calculate gross margin. Then we will subtract all non-manufacturing costs to get to net income. So here, under absorption costing, which is the first column, we have got revenue of 0 since we sold nothing. As a result, our cost of goods sold is beginning inventory of 0 plus cost of goods manufactured. Remember, we spent $50 per unit for 10,000 units, so 500,000. So we have $500,000 dollars worth of goods available for sale. Since all of it becomes our ending inventory under this method, our cost of goods sold turns out to be 0, gross margin is 0, all other fixed expenses are 0, and net income is 0. Under variable costing, the only difference is that we charge $40 a unit to cost of goods manufactured. As a result, our ending inventory would be $400,000 and fixed expenses of $100,000, which is $10 a unit times 10,000 units, would be charged as expenses of the period, leading to a negative net income of 100,000. Finally, in throughput costing, we would be charging only direct material as our cost of goods manufactured, so $30 a unit times 10,000 units, leading to a ending inventory of 300,000 and $100,000 of direct labor plus $100,000 of fixed expenses would be charged, fixed manufacturing expenses would be charged to the books as period expenses. So we have $200,000 expenses subtracted, leading to a net income of negative 200,000. Please note that the red color here is to simply show the negative numbers here. Let us try to solve a simple problem here. We are given all kinds of manufacturing and non-manufacturing costs. The first job is to figure out which ones are direct material, if you are doing throughput costing especially. Also, which ones are variable manufacturing and which ones are fixed manufacturing, and finally, which ones are non-manufacturing costs. A wrong classification will mess up all the calculations, so please be very careful at the very first stage. Let us read the first question. We need cost of ending inventory under variable costing. So, we need number of units in ending inventory times cost per unit. We see that the company made 50,000 units but sold only 40,000. So, ending inventory in units is 10,000 units. Under variable costing, we are going to use only variable manufacturing costs as inventoriable cost per unit, which is 30 plus 2 plus 3. The numbers in yellow. Are you with me? Under absorption costing, which is the second question, we will take all manufacturing costs as inventoriable costs. So it will be 30 plus 2 plus 3, which means all the variable manufacturing costs plus 25, which is the fixed manufacturing cost per unit. The yellow and the red costs have been included here. Please note that the two costs left in white color are non-manufacturing costs and will not be included under either method. Now it is easy to answer the next two questions. Under variable costing, cost of goods sold is going to be number of units sold times cost per unit, cost that we just calculated above under variable costing. So it will be 40,000 units times $35 a unit. Under absorption costing, it will be 40,000 units times $60 a unit. Are you with me? We are done with this problem. Now, let us look at a slightly bigger problem. Here, we are given revenue per unit and all other relevant numbers. We need to compute per unit costs, ending inventory, and net income under both the methods. But step first. Separate the costs out into variable manufacturing and fixed manufacturing and non-manufacturing costs. Then, total variable manufacturing costs for variable costing purposes, and then total variable manufacturing and fixed manufacturing costs for absorption costing purposes. Should we begin? Did you get the manufacturing labor cost per unit in this problem? Note that we make 4 units in 1 hour and pay $24 an hour. So per unit cost must be $24 divided by 4, which means $6 a unit. So under variable cost, what should be our unit cost? It should be $12 a unit. Did you get it? Under absorption costing, unit cost should be 16.40, which means 4.40 per unit of fixed manufacturing costs have been added to it. What should be the cost of ending inventory under the two methods? So here we have the solution for you. We have the absorption costing cost. Notice the fixed manufacturing overhead of $440 calculation. So we have $16.40 there and $12 for variable cost. Notice $12 gets repeated in both. It's the additional 4.40 of fixed manufacturing cost which really makes the difference between the two costs. Now we have a ending inventory calculation. You can see that we have used the same formula for our ending inventory calculation. Beginning inventory plus cost of goods manufactured minus ending inventory. So we have the ending inventory of 32,800 according to our per unit cost calculations. The number of units in ending inventory are 2,000 under both the methods, but the cost still turns out to be different. Now we are ready to make our income statements. Under the first method, which is absorption costing income statement, we have sales of 28,000 units at $20 a unit. We subtract cost of 28,000 units at 16.40. Remember the number we calculated earlier. We get to a gross margin and then we subtract all selling and administrative costs, giving us a operating income of $4,800. Under variable costing, we have the same sales revenue. Then we subtract variable manufacturing costs at $12 a unit. Then, just to be able to calculate the contribution margin, variable selling expenses would be deducted. Notice we did not use variable selling expenses in our calculation of cost of goods sold. They are just stacked under so that we can calculate contribution margin. Why? Because contribution margin is revenue minus all variable costs, whether manufacturing or non-manufacturing. So once we have the contribution margin, we subtract all type of fixed costs, manufacturing as well as non-manufacturing, and we get to a operating income of negative 400,000. Please note here that the red color is used for absorption costing numbers and not for negative numbers. Yellow color is used for variable costing number and for no other reason. In variable costing, net income is negative 400,000. So what is the difference in the two incomes? Notice that the difference is $8,800. Can you see why? Also, can you see that income under absorption costing is bigger than income under variable costing? Can you explain that why? There are two simple rules at play here. Under the first rule, if production is bigger than sales, then income under absorption costing will always be bigger than income under variable costing. If production is equal to sales, income under the two methods would be equal. If production is smaller than sales, then income under absorption costing would be smaller. This rule tells us if the income under one method is going to be higher or lower. It does not tell us how much it is going to be different by. This is given to us by Rule 2. Rule 2 says that the income between the two methods is different by the difference between production and sales multiplied by fixed manufacturing overhead per unit. Let us try to check it for our example. In our example, production is bigger than sales. Remember, production is 30,000 and sales are 28,000. So income under absorption costing should be bigger by our rule than income under variable costing. But by how much? Since the only reason for differences in two incomes is fixed manufacturing overhead, the incomes will be different by production minus sales, which is 2,000 units, times fixed manufacturing overhead rate. The rate here is $4.40 as we calculated. So $4.40 times 2,000 units will give us a difference of $8,800. Done. Here we have a problem that makes a 3-year comparison between incomes and highlights extreme differences between production and sales. Also, here we are given no production and sales units. So in first year, production is something. Let's call it 100%, but sale is 0%. In second and third year, production is 0%, but sale is 50%. Also, no fixed manufacturing overhead per unit can be calculated, so we will have to learn to work with the total number. Do you think you can make an income statement under each method? I'm quite sure you can if you started slowly and tried it out. In first year, sales and cost of goods sold and gross margin are all zero under absorption costing, but non-manufacturing costs of $40,000 have to be charged to books. So net loss in 2009 will be $40,000 under absorption costing. In year 2, 50% of ending inventory will be converted into cost of goods sold. And in year 3, the other 50% will be converted. So income is different under absorption costing for all the 3 years. Under variable costing, all fixed costs are charged to income statement as period expenses, leading to a higher loss in year 1. But since the company took the big hit in the first year, next 2 years' incomes are higher than in absorption costing. Can you check that if you made only one type of income statement, you could figure out the income under the second method using our formulas? Let us check to see if that works. Notice once again that in this problem, we are not given production and sales, so we just have to work with percentages. So in year 1, production is 100%, which is bigger than sales of 0%. So income in the year 1 should be bigger under absorption costing than in variable costing. We see that it is true because income in the first year is $40,000 under absorption costing and negative $120,000 under variable costing. Also notice that the incomes are different by $80,000. Can our second rule explain that? $80,000 is exactly equal to our fixed manufacturing overhead of 80,000 times 100 minus 0, which are our production and sales percentages. So we notice that our second rule works for the first year. For the second and third year, production is smaller than sales because our production was 0 and our sales was 50% in each year. So income under absorption costing should be smaller than income under variable costing. We see that it is true by how much we apply our second rule, and then we see that even this time it works. In general, there are 3 popular costing systems. You have seen all 3 of them before, but let's repeat them. Actual costing method is one in which the companies use actual costing, actual quantity, and actual price to price their products. Under standard costing, companies use budgeted or standard numbers to price their products. Finally, under normal costing, companies use actual quantities of goods used for actual production and multiply it by budgeted rates. Absorption or variable costing methods that we have just learned, they can be combined with each one of these methods. For example, absorption plus actual or variable plus actual or absorption plus standard or variable plus standard. So we can make 6 different alternatives that companies have to choose for their costing purposes. If a company ends up choosing normal costing, which is very popular and is also recommended by IRS, then it is going to use a budgeted manufacturing overhead rate to apply fixed costs. Remember applied overheads? You have seen this before. We are going to refresh it a little bit. if we apply manufacturing overhead rate to actual production, we might see a production volume variance. Let us see what that is and how it is calculated. Let's use this simple example. Suppose a company plans to produce 8,000 units and they have budgeted fixed manufacturing costs of $400,000 for a year. So at the beginning of the year, if they see these two numbers, they are going to want to apply a rate of $400,000 divided by 8,000 units, which is their budgeted fixed cost divided by their budgeted driver. So they would come up with a rate of $50 per unit. So as the production goes on during the year, they are going to apply a rate of $50 per unit. By the end of the year, if they have made 10,000 units, you can see that they would have applied $500,000 to production. 100,000 units at $50 a unit. Since their fixed cost at the beginning of the year were only 400,000, this is going to lead to a production volume variance of 100,000. Favorable. Why is it favorable? Because your costs were 400,000, but you applied 500,000. In other words, you over applied cost. So you have to subtract that from your cost of goods sold in order to adjust it. Similarly, if you under apply, then you will have to add it to cost of goods sold, leading to a higher or lower cost of goods sold, as the case may be. This brings us to a point of denominator level capacity. Denominator is the number of driver that you use to divide to get your budgeted manufacturing overhead rate. So there are many different choices available, but each of these numbers is going to lead to a different manufacturing overhead rate, therefore a different cost of goods sold, and therefore a different income level. Typically, there are 4 types of numbers available as denominator level. Theoretical capacity is a capacity that the company can achieve with their best possible effort, working 24/7, 3 shifts, taking no breaks, etc. Practical capacity is what a company can achieve with reasonable amount of downtime estimation, small amount of breakdown and repair and maintenance provision and stuff like that. So something that they can really achieve. Normal capacity is what the company can normally produce in a normal year. And finally, master budget capacity is what the company plans to produce next year in their master budget for whatever reasons. The master budget capacity could be higher or lower than their normal capacity depending on what their order volume is. So here we have a simple example to show you how denominator level capacity comes into action. This is a company that manufactures watches. Next year they are planning to produce 440 watches, even though they can produce 500 watches each day. So that is their theoretical capacity. But they are more likely to produce 450, which is their practical capacity. The demand for the next 3 years is expected to average 425 watches. So this looks like their normal capacity. Finally, master budget is what they plan to make next year. So that is 440. So you have 4 different levels of denominator levels to choose from, even though the fixed manufacturing cost is $336,600. The company also plans to work 20 days a month, which means when you are calculating a rate, you will have to multiply the number of the days with the per day production. Let us see the calculations. Theoretical overhead rate would be dollar cost divided by 500 units times 20 days in a month, so 33.66. You can calculate the overhead rate for all the 4 capacity levels, and notice that the bigger the denominator, the smaller the rate. So in theoretical overhead, the rate is going to turn out to be the smallest, and the rate is going to turn out to be the biggest under normal capacity, because that number is the smallest number of the 4. As I said before, there are some dangers in choosing a wrong capacity level. If you are choosing too high a number, then your overhead rate is going to turn out to be very small, which means your total cost is going to look like a lower cost number than it really is, leading to a wrong pricing decision. Suppose someone offers you a good at, let's say, $30 a unit. You are not going to accept it because you think that all your costs, no matter how they are made, are not going to be met. But suppose someone offers you a $35 a unit price for your good, and you happen to be using a theoretical overhead rate. You will tend to accept that because 35 is higher than 33. but you know that theoretical overhead rate is hard to achieve. So your normal capacity is what should have been considered, which means 39.6 is higher than the 35 that someone is offering. So you might end up accepting an order for a loss. Sometimes what also happens is that the company uses too high a rate. As a result, their cost per unit is too high and they keep denying orders because the price offered is too low. So if they supply too little a number during the year, then their demand is going to become smaller and smaller, which means that the fixed overhead rate is going to be divided by smaller number of units in a year, leading to even bigger per unit cost, leading to even smaller demand. The other problem that can happen in choosing a wrong capacity level is that the managers can be tempted to overbuild capacity. They can have a capacity which they know that they are never likely to use, but still can have it so that they can push the fixed manufacturing overhead cost by overbuilding the inventory into next years. So all these dangers are there in trying to pick a correct capacity level. What is a correct capacity level for the company depends on what their previous and current demand, also what their future demand is likely to be, and what is it that they can achieve normally.